Hello, everyone. Today I'm going to talk about the very basic accounting information in relation to the corporate finance. You may have learned some of the introductory financial accounting, but those are really quite basic. And so in this video, I'm going to talk a little bit more about the financial accounting in the context of the IFRS, introduce to you some of the basic formats, and also we're going to put a little bit more focus on the cash flow as this strongly related to the finance part. So what is the statement of financial position, right? In the introductory financial accounting, you may have learned about there are 4 financial statements, right? So you have the statement of financial position, right? You also have the statement of comprehensive income statement, right? You also have the statement of the changes in the equities, right? And you also have the statement of cash flow. So those are the 4 financial statements. So the first one is called the statement of financial position, and often we call it balance sheet. So on this balance sheet, it provides information of the firm's asset, liabilities, and equities at a specific time point. Okay, so often it's at the end of, for the fiscal year financial statement, often this information is as of the year end. Okay, so this information, okay, will be listed in the order of liquidity. Okay, so for example, often under the current asset section, you would have cash, right? Because cash is the most liquid items, right? Is the most liquid asset. So this liquidity measures how easy this item, this asset item, can be converted into cash and without a significant loss of the value. Okay, and so the equation, I guess you're all fairly familiar with. Asset equals liabilities plus shareholders, stockholders' equity. So one way to present it, you can present it having the asset section on the left, liability and equity on the right side. Okay, and then you present the current asset, current liability on the top. Okay, so you break the assets section on the left side into 2 subsections, current assets and long-term, or we call it fixed assets. That would include intangible fixed asset. Those assets you can touch it, like houses, building, vehicle, car, and the intangible assets could be software, patent, could be copyright, right? Those kind of things that you cannot touch it, right? It's intangible, but it has the ability to generate future cash flows. Move on to the right side, those will be the liability and equity section. On the top, you have the current liability, and then you have the long-term debt, and at the bottom, you have the shareholders' equity. Okay, so very important terminologies in finance is the net working capital. Okay, so what is the net working capital? So that would be the current asset minus current liability. So when you take the difference between current asset and the current liability, and that gives you the net working capital. Okay, so if the company is healthy, okay, you should have enough current asset to pay off the current liability. Okay, so normally we are saying the business cycle would be 12 months. Okay, so you are hoping that you have enough current asset to available on hand so that you are able to pay off the current liability. Okay, so in this way, in any working cycles, in any 12 months period, you are not owing anything. You have sufficient resources to cover your liability. So what's the liquidity? Liquidity measures the ability to convert to cash quickly without a significant loss in value. Okay. If you are liquid firms, you are most unlikely to experience financial distress, right? So you have lots of cash on hand. Okay, if you have some debtor, you have some creditors, they need money from you. They need you to pay off their money. You have lots of cash on hand, right? So you just pay them the cash, right? However, let's say in your company, you are not very liquid. Okay, you have very little cash, but you have large amount of asset like houses, right? If the creditor demand money to be paid back to you from you, you don't have cash, so then you probably have to sell your long-term assets, right? In order to have the cash to pay off the current liability. But as we know that it is not that easy to sell a house, right? Sell a capital, because just by nature, the real estate takes some time, right, to be sold. In the hot areas like Vancouver, Toronto, sometimes in the good market, the houses can be sold very quickly. Okay, in Vancouver, sometimes there are the bid wars prior to the COVID or even during the COVID time. So like 30, 40 people have a bid war try to buy the same house, right? So in any case, these houses can be sold very quickly. But in general, the long-term asset for business are slow, right, to sell. So if your assets are tied up to the long-term capital, those ones that are not very liquid, you may run into a problem that you don't have the cash flow to pay off your current liabilities. Okay. So then you may ask, well, then if liquidity is important, then I should just keep as much cash as I can, right? But the problem is, okay, the problem for that is that the cash does not earn a lot of return. Okay, if you have cash in the bank, okay, how much interest rate can you earn? Well, now because of the hike of the interest rate, last year in 2022, so the interest rate is better, much better now, right? But in the most of the time, you earn better returns by investing your cash, right? Not by keeping those cash in the money, right? If you want your cash to be available anytime, you cannot do GIC, those kind of like 1 year, 6 months locked in type of option, right? So in those cases, that if you only have cash free to use, right, free to move around, those cash just doesn't generate very good return. So therefore, there's a trade-off between liquid versus illiquid assets. So this is one example of the statement of financial position. So the format would be in the middle, on the very top, you're gonna specify the name of the corporation. In this case, is the Canadian Tire Corporation Limited. And then the next line, you're gonna describe the title of the statement. So that's a statement of financial position, right? As of December 2018 and 2019, and in millions, right? The numbers are in millions. So you can see in this case, the current asset, this would be 58 in 2018. So that is, okay, let me use this. So in 2018, the current asset is 92.55 million, okay? And so that is the current asset. That's the current asset, okay? This is the current asset for 2018. The current liability for 2018 is 58 million, okay? So now knowing that what is my net working capital, NWC, net working capital, so that's the current asset minus current liability. So the difference, that will be here, 6 minus 2, that's 4. And I got a 7 here. Okay, so I got a 7 here, so that's 4. I get a 9. I get a 9, and I get a 3. So I think if I'm correct, so the net working capital is will be, sorry, $39.97 million. So that's your net. That's your net. Okay. And make sure when you see a balance sheet, a statement of financial position, this equation has to be balanced. So the assets equals liability plus equity. So those are the basics here. So in this case, because the current asset is more than current liability, your net working capital is positive. Therefore, we can say this is a healthy company, right? Canadian Tire probably doing pretty well. Okay, so now we talk about value versus cost. Okay. So here the publisher was saying that the statement of financial position provide book value of the assets, liability, and equity. This expression is not necessary. It does not it's not perfect. Okay, because according to IFRS, the statement of financial position can provide the market value of the asset. Okay, so what is the market value? Market value is the price at which the assets, liabilities, or equity can actually be bought or sold. So market value is when you start having this trading exchange, right? So that's the time you would figure out what is the market value. It has to be a value implied by the market. So market value and book value are very different. Book value is what you paid for. Market value is what it is worth today, right? Which is more important to decision-making process. So this is very interesting. When I was teaching the intermediate financial accounting course, we discussed about two concepts that are in the business decision process. One is called relevancy, right? So the information you are talking about has to be relevant. The other one we talk about is called reliability, right? So is your number reliable, right? So so it's two perspectives, right? You could have very reliable numbers, but it doesn't help with solving the problem, right? So reliable, irrelevant, right? You could also have relevant information, but not reliable, right? So you want to know how much I can sell the house now, how much is my house worth, right? That's obviously apparent, is relevant to my decision whether I'm selling my house. But because the market is fluctuate, maybe I will get an appraiser to assess the value of my house, but again, that assessment may not be reliable, right? Especially in such a quick changing market. Okay, so I would say in this case, the book value is reliable, okay, and the market value is relevant, okay? Because if you want to sell something today, the market value is relevant, right? But if you already bought something and you paid a price, then the book value is reliable because that's what you paid, but it is less relevant. International Financial Reporting Standards, in short, that's IFRS, allows company to use historical cost method, okay? And allows the use of revaluation method. So now you can see, right? So IFRS allow company not only to report using cost method, but also allow to use the revaluation fair market value method. Okay. all items in an asset class should be revalued simultaneously. So if you revalued like an asset class, let's say you are evaluating all the cars, right? So basically, what we are saying here is all the items, all the cars in that car vehicle class should be revalued simultaneously. Revaluation should be performed with enough regularity to ensure the carrying amount is not materially different from the fair value. Okay, so you perform the revaluation frequently, okay, regularly, so that the book value, the carrying amount, is not materially different from the fair value. Okay, so in this example, okay, they are comparing the book value versus fair value. And you can see that the book value of the net working capital is 400, but the market is $200 more, so 600. The net fixed value, according to the book, what you paid, and less the amortization, that's the $700. But on the market, you can sell it for 1,000. Okay. So you can see that when you are using a different value method, you can lead into a lot of differences, right, on the financial statement. A statement of comprehensive income. The statement of comprehensive income, this one record all the activities, the behaviors for that reporting period. Okay. You generally report revenue at the top, followed by expenses. Okay. IFRS honoring a matching principle, it says that to show revenue, when it accrues, must match expenses required to generate revenue. So if you have a building, okay, you have a building, and you use that building to host the classes, right? Yoga classes. Okay, that business requires a space, right? So you have a building, and you use that building for ballet dancing players, right? So in that case, that building generates a lot of revenue because these people, when they came to your building, they pay money, they pay membership. The idea is you have to match the expenses required to generate the revenue. Okay, you have to match the expenses required to generate the revenue. So, well, I'm generating this membership, income because I have a place to hold their performance. I have a place, I have some room here for them to practice, right? So therefore, they come here, they wear out the house, right? You have to recognize the value of using the house. Without that house, you cannot have this business, right? So therefore, when you recognize the revenue, you have to recognize the usage, the wear out cost of the assets, right? Of the assets. So in this case, that'll be depreciation, right? Depreciation. So this is one example, okay? So you have revenue, you have cost of producing revenue, other cost, depreciation, okay? Then you get earnings before interest and tax. So I'm going to talk about this. This is an important number. Earnings before interest and tax. So in short, we take the first letter of each word, EBIT, okay, EBIT. That's the EBIT. And you calculate the EBIT, and then you figure out what's the interest paid and what's the income tax paid, and then you get the net income, okay, you get net income. Okay, so this is the income statement. Okay, it's not a comprehensive income statement. This is just an income statement to know the current year's normal business operation. Okay. So basically, you can look for some resources, right? If you are interested in reading this type of information. So the publicly traded companies must file regular reports with Ontario Security Commission. This is a mandatory requirement. This report are usually filed electronically and can be searched at CEDAR site. So if you go to CEDAR site, you may be able to find this report. Now let's talk about the cash flow. Okay, cash flow. Over the years, I was teaching cash flow. I always use a parable, which I think is pretty interesting. So basically, cash flow is really important. If you are in finance major, you must have heard of the terminology of cash is a king. Okay, cash is the king. So the cash flow, okay, the cash flow is one of the most important pieces of information that a financial manager can derive from a financial statement. So the cash flow statement is really important. Okay. You could have a lot of asset, but suffering from cash flow. Okay. I'll say that again. You may have a large amount of asset, but you may suffer in cash flow. So one good example would be what is going on to the real estate developers in China. Okay. So when the economy is good before COVID, the real estate industry is the hottest market. People in it makes tons of money. Okay. So what is how this business works, right? So basically, the real estate developers, they will obtain lands from the government, and then they will ask the buyers to sign the contract to pay maybe quite a substantial percentage of the house value before the house is even grounded, right? Before they even start digging on the dirt. So if at this time, the real estate company, they use the money collected for the next project, right? So then let's say at this time, the economy is really bad, people are panicking, they want to get back their money, right? So that you have a large amount of asset. You could have like 2,200,000 houses in China doing this business, but you also have lots of huge amount of debt, right? So the idea here is that you could have large amount of asset, right? You could have houses everywhere, right? But you may suffer from a cash flow problem, right? So nobody will buy this asset anymore because the negativity media effect, right? We'll look at how cash is generated from utilizing cash, using asset, and how it is paid to those that finance the purchase of the asset. So again, if you are interested in reading more of this type of reports, you can search it at a CEDAR night, okay, CEDAR site. Okay, back to this equation. Asset equals liability plus equity. What is asset? Asset is the amount of money you due to creditor. What is equity? Equity is the cash for the shareholder. Okay, so cash flow from asset equals cash flow to creditor plus cash flow to shareholders. Okay, cash flow from asset, the way you can calculate it is you use the operating cash flow minus net capital spending minus changes in minus changes in non-capital. What is NWC? NWC is the net working oh boy. So it's net working capital. Boy, I hate it. Sorry. So this is net working NWC, net working capital. Okay, so this is the equation you just learned. You given any of the three number, actually 1, 2, 1, 2, 3, 4. Given any of the 3 out of 4, you will be able to calculate the unknown. Okay, so cash flow from the asset of the company, some of them, that equals operating cash flow, how much cash received, minus net capital spending, how much money they used for expansion, and the changes in net working capital, net working capital. So far, we have talked about these two, this one and this one. Now, how do you calculate operating cash flow? Well, operating cash flow equals EBIT, earnings before income and tax, plus depreciation minus tax. So if you want to calculate operating cash flow, you use EBIT plus depreciation minus taxes. Okay, minus taxes. So that is the operating cash flow, net capital spending. So net capital spending equals the ending net fixed asset. So again, this is net, be careful. Sometimes there's something quite special about the long-term asset, the capital asset, right? You have a cost account, you also have a cumulative depreciation account, right? So you always debit your cost account, that's the actual amount of money you spend, and the cumulative depreciation, that's account accumulating the amount of depreciation from the beginning until the reporting time. Okay, so in this way, when we say net fixed asset, what we mean is the original cost minus cumulative depreciation. So you use ending minus beginning and plus depreciation. That is the net capital spending. So if you don't understand that, let's go with another way. So what do you have? You have a beginning to start with. You have a beginning net fixed asset, right? You have the beginning net fixed asset. And then let's say you have some net capital spending. So what do you have before plus today's net capital spending? Net capital spending. Okay. And minus and also minus depreciation and equals ending NFA. Okay, does this make sense? So you start with a balance, a net fixed asset. During the year, you have capital spending, right? Let's say you buy something, you add them up, and then you minus the depreciation due to the matching principle, and that's your ending. Now that's your ending net fixed asset. Okay, so then when you move this to the one side, okay, you would get exactly this equation. The last is the changes in net working capital. So you can calculate the net working capital by using current asset minus current liability. So how do you calculate the changes? the changes in net working capital is the ending net working capital minus the beginning net working capital. So this is very important. You don't want to mix up with this, okay? You don't have to mix up. You don't want to mix up with this. So ending net working capital minus beginning net working capital. What about the cash flow? Cash flow to creditors. Okay, so cash flow to creditors. That means you pay money interest back to the bank. So interest paid. And what if you borrow more money from the banker creditor? Well, they're gonna be a cash flow from the bank to you. So therefore, you minus the net new borrowing. Okay. Okay, cash paid. Okay, so this, I will use a picture. This is the bank creditor. And this bank is a creditor, right? Creditor. And this is the company, C, company. So the cash flow to director, to creditor is this direction. Okay. Yeah. So this direction, we say this. So creditor to cash flow to creditor. So you need to pay the interest expense, right? Interest expense. And meantime, you may get new borrowings, borrowings. So the interest expense goes to the creditor, but the net borrowing, is a cash flow from the creditor to the company. So therefore, the cash flow to the creditors is the interest paid minus net new borrowing, because they are in opposite direction. Therefore, you use minus. Cash flow to shareholder loan is the same idea. We pay shareholder dividends, okay, but they may use the money to buy new stocks. So therefore, cash flow to the shareholders is the dividend paid minus new equity raised. When the new equity raised, the shareholders will bring money to the firm, right, to the company. Okay, now let's work on this. We have current asset information for 2 years, fixed asset depreciation for 2 years, long-term liability and equity, so 2 years, statement of comprehensive income information. So that's EBIT, interest expenses, tax, dividend. So the example first is, let's work on OCF, operating cash flow. Operating cash flow, okay, operating cash flow. So that equals what? EBIT. Okay, EBIT. Then you want to minus tax expenses. EBIT plus depreciation. Let's take a look. EBB 2700. Depreciation 300. Tax, personal tax corporate tax. 1,000. So 27 plus 300 minus 1,000. So what I got 3. No, I got 2,000. Okay, next, net NCS. So NCS, what is NCS? So OCF is operation of cash flow. Okay, operation of cash flow. So what is NCS? What is NCS? So is that net capital spending? Yes. Okay. Net capital spending. Capital spending. So the net capital spending, that's the ending fixed asset minus beginning fixed asset plus depreciation. So what is the ending fixed asset? So the ending fixed asset would be here, 4,000. And okay, beginning fixed asset. Beginning fixed asset is 3,000. Depreciation, that is 300. So we got 1,300. Bingo. Yeah, bingo. This is correct. This is correct. Now changes in net working capital. So net working capital is current asset minus current liability. So this year is 2021, and this year is 2022. Okay. So current for the 2021, the current liability asset is 2,000. The current liability is 1,700. So the 2021, the net working capital is 2,000 minus 1,700. So that's 3,000. So that is the 2021, the ending. The beginning is 1,500 minus current liability 1,300. So the difference is 1,500 minus 1,300. That is the net working capital for the 2020. Now let's take the difference. We realize that the changes in net working capital is only 100. Only 100. Now let's think about the cash flow from asset, right? Cash flow from asset. So that would be operating cash flow, OCF. Okay, OCF and minus NCS minus changes in NWC. So now let's do a calculation. OCF, that's the $2,000 minus net capital spending 1,300, and minus the change in net working process, in change in net working capital. So that is 100. So together we get 600. We get 600. And now let's think about the cash flow to bondholders. Bondholders. So cash flow to the creditors, because you pay the interest. So that's 200. Here, that's the interest, 200. And minus the new loan you obtained from the bank. So do we have any new loans? Okay, now let's take a look at here. 2021 long-term debt is 2,800, but 2020 the long-term debt is only 2,200. So therefore, the difference is 600. Okay, so 2,200 minus 600, you get a negative 400. Last, let's consider the cash flow to the shareholder. Well, to the shareholder, you first give the cash to the shareholder, so that is your dividend. The dividend is 12.50. And also, you want to consider the new share issued, right? New share issued. You can see in 2022, the return earnings is 750, but in 2020, that's 500. So there is additional issuance of the stock. So you are going to use 750,100 minus 500. That would solve the value of the new equity issues. So I get 1,000 for this. Now let's put them to a test. Okay, so cash flow from bondholders is negative 400. Cash flow to shareholders is 1,000. Together, that's 600. That is the cash flow from asset. Okay? That is my today's lecture. Have a wonderful day.